Well, I'll get started while Jordy pulls up my slides. I would say I don't think my slides are anywhere near as good as Jeff's or Cheyenne's, so I want to give you that warning right up front. My name is David Morton. I'm a partner at Rocaton Investment Advisors. Rocaton is the partner with Lexington. We provide research into investment products, markets, try and give them our know-how from an objective point of view. We have a 3-year relationship now. It's been a great partnership. We appreciate it. I think it works well from our point of view and hopefully works well from Lexington's. And kudos to Mike and team for the video that you showed at the front at the beginning of the session. I thought it was very well received from our point of view. When you present who you are, it resonates with us at Rocaton because we're a relatively small firm. And on our kitchen wall, we have our values. And the first value at the top of the wall is our clients come first. That's important to us. What that means to us is that we put your Lexington's clients' objectives first when we're considering what we're doing in terms of recommending investment products, when we're looking at financial markets, trying to think of what's going to happen in the future. And I think that's a great alignment. And that's the way that we wanted to run our business. Clearly, it's the way that Lexington wants to run its business. So glad that you all made it here tonight. And I got a little good news and I got some less good news. And there's plenty of areas of agreement between myself, Jeff, and Cheyenne. I'm not going to go over all the areas in detail where we agree. Probably try and sort of deal with some areas where maybe we have a difference of opinion, perhaps where we at Rocaton would maybe look at things a little bit differently than Jeff and Cheyenne. And I guess the first thing I would throw out is you've listened to both presentations. You're probably saying to yourself, okay, they were both very good presenters and lots of colorful charts, lots of good information, but what do I do? What do I do next? I've got this portfolio, have a certain amount of wealth, want to protect it, want to see out and achieve various objectives over the next few years, but I'm afraid. I'm afraid of what happens next. I'm afraid of where markets are. I'm afraid of where the economy is. I'm afraid of politics. I'm afraid of North Korea. You name it. Lots of things to be concerned about and afraid of. And I would say to you, I'd raise one question, maybe a couple of questions to you. How many of you think that you know what the stock market's going to do in 2018? Well, you may already know this, but none of us three know that either, right? We have no idea. So it always humors me when I rarely watch CNBC. When I return on CNBC, presenter after presenter after presenter tells you what's going to happen in the stock market. They're so much smarter than I am. I have no idea what's going to happen in the stock market. How is it that these guys know? What school did they go to? What course did they take? What book did they read? I don't know. I have no idea. I actually think, I'm not sure if it was Albert Einstein, I was trying to think of this as I was listening to the other two present. I think maybe it was Albert Einstein said, the most important thing I ever realized was the limit of my knowledge. And if any of you know who actually said that, and it wasn't Albert Einstein, I apologize. But I think we have to sort of, when we're thinking about decisions made under uncertainty, which we always are in investment markets for your portfolios, we have to understand what it is we know and what it is we don't know. We don't know what happens to the stock market next year. None of us have ever predicted a stock market crash. So in the last 20 years, even the last 18 years, the stock market's fallen about 50% twice. None of us experts predicted it. So by all means, enjoy what we have to say, shake our hands, have a drink with us. We have lots of interesting things to tell you. We don't know what's going to happen. Right? So you might say, well, what kind of a strategist are you? Who pays you? Ultimately you do. And people like you do. So with that said, I think there's some good news and there's some sort of challenges out there that we know about. And I'm not necessarily a Donald Rumsfeld fan, but when he said there were known unknowns, known knowns, and unknown unknowns, those are things that you should think about in your investment portfolio, right? North Korea. There's a known unknown. Right? We know that it's a potential problem, but it's been a potential problem for 50, 60 years. So what's different now? Maybe nothing. Right? There's unknowns out there that we haven't thought about. So the credit crisis, right? I think I heard it stated that debt has never caused a market crash before. Well, it has. The credit crisis it was caused by an overhang of debt and lots of other things as well. But it was over-indebtedness that ultimately caused that. Each crisis that comes along, so if you think back to the crash in 87, the market crash in 89, which just passed the anniversary of, the crash from 2000 through 2002, the credit crisis, each crash is different than the last one. So to say we can look at historical data and what it points to and that it shows a pattern that we can then act on is just plainly false. The next crisis will look different. And so it's not clear what piece of data we necessarily need to be able to pull out and think about and internalize to decide, have I got the right amount of risk in my portfolio or have I got the wrong amount of risk in my portfolio? So with that sort of confusion, further confusion thrown into the works, let me sort of perhaps go through a few of the slides that we have and try and sort of maybe suggest some things that we can think about. So again, yeah, right. Okay. Am I pressing it the wrong way? Here we go.
There you go.
I did say our slides aren't as good, so you now know that I'm not a liar, or at least I didn't lie about that point. So I think, cheerful and cautious. Cheerful because there are some good things going on. Cautious because of some things I'll talk about later. But the things that, in our view, and again, I'm not going to belabor the things that I'm in agreement with what Jeff and Cheyenne said. So global growth prospects are better. They're materially better in some places. Brazil is now coming out of recession. Chinese growth is relatively stable, assuming you believe the numbers. From China. I'd say that we don't believe the numbers from China, but everybody that trades with China is doing well. So sort of if you look at that second derivative, it seems to us that Chinese growth is pretty good. I'll go through these other points in a second, but global growth, just to, I'm not sure that these particular bars exemplify sort of what's going on, but we've seen from the beginning of this year, we expected flat growth in the US, weak growth in Europe, weak growth in Japan, and we weren't too sure about emerging markets and whether they were going to sort of pull through. As we sit here today, sort of 10 months later, Europe's been a great story on a relative basis. We're starting from a really low level, but Europe is definitely moving in a positive direction, and I'll talk about that a little more in a few minutes. But Japan is doing better. Again, from a low base. China's stable, and perhaps that will help the US get out of second gear. Our growth has been very, very flat at sort of that 2% level. Perhaps we'll find a way to sort of get pulled up by the rest of the world as other parts of the world start to grow. I think one of the best pieces of news this year was European politics. Now, that might not have been sort of the major issue that you came to tonight to think about. But if you think about the risks to markets that we've seen in the last 10 years, one of them was a fragmentation and falling apart of Europe. 2011, 2012, 13, 14, we had the Greek crisis, we had the Spanish crisis, Italy, so on and so forth. And you might tell from my accent that I'm from New York. But I'm originally from the UK, and the UK has a strange relationship with the rest of Europe that goes back thousands of years. Right? We really do think they are going to come and invade us because they've done it before. Right? So sort of keeping that channel there and keeping them at bay is what we're all about. But ignore the British for a moment. What we thought at the beginning of this year was that we had significant political risk within Europe. We still had problems in Greece, and whether the Germans were ultimately going to pay the bill for Greece. It looked at the beginning of the year like they were. but different factions with the Bundesbank and German politics could have decided to go a different direction, but they haven't done it at this point. The first major, there's some more elections than what's listed on here, but the first election was in the Netherlands. There was fear that the right-wing fascists were going to make ground in the Netherlands, and they didn't. The centre of Dutch politics held. Then we had the French election. The centre of French politics held really solidly, and by far greater an extent than anybody predicted. We pay for a research service, which is actually very good most of the time. They predicted that the fascists would win in France 2 weeks before the election, and it couldn't have been more wrong. It was almost exactly the opposite outcome that they had predicted. Then we had the German election, and what you read in the media from the German election was the fascists got 13% of the vote. That was the headline, and that's disturbing, no question about it. I have relatives that fought in both the First World War and the Second World War, don't want to see a resurgence of fascism in Germany or anywhere else in Europe. But what the real story should have been that the media told was 87% of Germans voted against the fascists. And the centre of German politics held, the centre of European politics held, so the European Union is going to stay together, period. Now, I knew that as a European before this year started, because a European project is much more important to the Europeans than Americans generally realize. Europeans want to be European. And so I think a lot of the talk of, the Germans were going to pay for the Greeks and so on and so forth was posturing because the Germans didn't want to pay a really big check. They're really talking down the size of the check that they had to pay. But they wanted Greece to stay in because ultimately if Greece left, they'd have to pay a bigger check, ultimately to fix the recession that would have followed from that. So I think, what's happening in Europe today, you've got a brand new president in France. Is very young, seems to like to arm wrestle American presidents, and seems to have done it pretty successfully so far. He's got lots of new ideas. We've got Angela Merkel with her 4th term, a weaker coalition, but still a coalition. I would say to you that I think it's impressive that she was voted in for a 4th term after letting in 800, 900,000 immigrants into Germany. I think that's a pretty impressive political feat. So kudos to her. Kudos to the European sort of centre of politics. But what this really means is take Europe off the table as a potential risk. So those known knowns, in this case, European risk to financial markets, I think is something that's going to recede. And from projections of growth, most of Europe is doing much better this year than it's done in previous years. Oh, gone the wrong direction. This was mentioned by Cheyenne. I think it's an amazing story. Even if you're not invested in energy, just read about energy, find out about it. It's a real sort of success story for American business, finance, innovation, scientific application to an industry, and the market focuses on oil all the time. It's all about oil prices. It's sort of selfish commodity. It's all about oil all the time. The real story, I think, is even stronger than that, and it's natural gas. It's natural gas that killed coal. It's natural gas that will fuel our electric cars in the future. It's natural gas that will create a new export industry. It's natural gas that will create a new chemical industry, plastics industry, and so on and so forth. But it's something that we're going to export. It's going to be a bigger part of our economy. More interesting ways to play it. We've talked about MLPs as a way to play sort of the build out of natural gas infrastructure, crude oil infrastructure. There's also some private investments that we've looked at that essentially are building new infrastructure in the energy market. A couple of ways to sort of play the expansion of that industry. Returns have been good. Another reason to be cheerful. You're all sitting there looking each month when you get your statements. It's been a pretty good story. Keeps going up. You have more money next month and the month after. The month after, it should make you feel good. I think our primary role is Rocaton working with Lexington and helping you is helping you preserve that and maintain it over many more years to come and generations to come. So what should we be worried about? I think you should be worried about valuations. And I would integrate part of Cheyenne's comments and set up when he talked about sort of the bond market and central bank activity in markets. We wrote a white paper a few years ago where we took our cue from one of the great Austrian economists, Friedrich Hayek, who wrote that the only real important piece of data that you need is price. And if price is left alone, if market participants are able to set the price, then you'll have a normal functioning economy where all of the people involved in it can transact at a fair and appropriate level of price. And as soon as you get governments manipulating that price, so in this case, central banks turning up and buying literally trillions and trillions of dollars worth of securities, you get skew in prices. All of a sudden, bond prices are too high. The yield that you get on your fixed income investments for the best part of a decade, and arguably longer, is too low. So it forces you into the equity market, forces everybody into the equity market, forces Japanese banks to buy emerging market debt and high yield by bringing the money here. It forces everybody to move further out on the risk curve. That's not an accident, that's what the Federal Reserve wanted. Back in 2009, they were worried about a deep depression. And what they did was they flooded the market with cash and continued to do it for years and years and years. And that happened in Europe with the ECB. It happened in Japan with the Bank of Japan. And the Chinese have lots of money that they've exported as well. So you've got all of this trillions of dollars sloshing around in world financial markets. Prices are high. So yes, your returns are great. But your returns are great because there is this, I would call it a bubble of money, government money, that's been injected into the financial system over the last decade or so. The trick is what happens next. I would agree with Cheyenne's comments that to the extent that the Federal Reserve starts to roll off its balance sheet, reduce the size of its balance sheet, or even sell some securities, I don't believe that interest rates are going to rise a lot. It's one of the great sort of behavioral surprises, I think, for people like myself in the role that we play, is thinking about interest rates and investor behavior regarding interest rates. For the last 15 years, easily, every client I've talked to thought interest rates were going up the next year. And then what happens at the end of the year? They've gone down. And then you have the conversation again, what do you think is going to happen to interest rates next year? They're going up. And then they go down again. This happens for 15 years. So what does everybody think now? So we get the intuition why rates are low, why they should rise. And if you look at history, perhaps there's some evidence there that suggests they should rise. We take the other side of it. And I think we would agree with Cheyenne's comments that there's just not enough growth out there to be able to support much higher interest rates in the marketplace. Let's just say we woke up tomorrow and interest rates were 1% higher. Stock market would sell off. Federal Reserve would cut rates because they're afraid of the stock market falling, have been for many, many years now. And you'd be back into this cycle of low rates again. Or if we slowly floated interest rates higher for a year or so, that might get to the recession that Jeff was talking about. If we get to a recession, it means the Fed's going to start to want to stimulate again, or it's going to slow the economy, and the market will expect that the economy will slow and interest rates should fall as a result. So it feels like we should be sort of still stuck in this low interest rate environment. It's hard to see how we'd exactly get out of it, because again, if you see rates at a different level higher, all of the other things that need to happen or might happen as a result of that all suggest to us that rates would come back down again, that it would really spook the world financial system. So let me move forward a little bit, because I'm aware that I've been talking, I still haven't told you what you should do. So I don't think any of us would disagree with this point. The real answer is diversification going forward. This is a chart. I don't know, maybe we should call it the Halloween chart. It looks pretty scary. Maybe we should just call it the scary chart. This is a two falls in value of the stock market in the last 18 years. Both times cumulative or top to bottom about 50%. So that's quite a painful experience if you remember it. Again, going back to what I said to you at the beginning, none of us predicted it. None of us have the ability to predict it. You should expect that nobody knows what's going to cause it, whether it's going to happen, when it will happen. All of that is not known. And anybody who tells you otherwise, again, find out where they went to school, what they read, have your kids, grandkids do the same things, because that's a pretty successful trick. But we would suggest we don't know, and therefore the only way to deal with it, protect your portfolio and the value that you've built, the wealth that you've built, is to be well diversified and to ask yourself what happens to your portfolio if this happens again. And that means to us that you need to be cautious about your stock market investments. By all means, even if we were certain that this was going to happen again, it might be 5 years from now. So to Jeff's point earlier, we don't know, the next recession doesn't look like it's in the next 12 months if you just looked at interest rate data. So it could be far out. So you don't want to be completely out of the stock market with your investments because it could be many years of growth that you miss out on. And we're not doing you a service by telling you to avoid being invested in the stock market in that case. But still, it could be next year that we get this sell-off. So figure out for yourself with your advisor what the right amount of risk is for your portfolio, and perhaps what do you have in your portfolio that'll help you during these time frames, that will give you a nice income or will give you some protection and diversification versus just being invested in the stock market. Just quickly, I mentioned this before, we do work with Lexington and offer some access to alternative investments, that be real estate, private equity, alternative credit funds, hedge funds. Those are very sort of customized typically, and I don't think we recommend them broadly. And there's times when we recommend them aggressively and times when we are less interested in recommending them. Today, it's harder to find things that are screamingly cheap in the world. So I don't feel like this is a time where you should be brave and go to very new things and do a lot of new things. This is a time to be cautious and protective of what you've already built. Don't attempt to predict the market. Be cautious. We do think that there's problems in the architecture of financial markets today which cause sectors to sell off periodically and give us some opportunities. Right after the election last year, higher yielding municipals sold off materially, and we thought that was a slam dunk for clients. Just for a short period of time, worked out really well at that point in time. There were some other things that we did around the energy price fall. So I think there are some things at times if the market gets spooked by something that you can do. But focus on diversification. Figure out what the right amount of risk is for you if we do get into one of these very unpleasant periods in the world, because we would expect that we will have them. We don't know what will cause it. We don't know whether it will be interest rates, the Fed reducing the size of its balance sheet, or something that nobody ever expected. So with that, I'll finish, and I think we'll start the panel.
Thanks, Dave.